My name's Kecia Rust. I'm the Executive Director of the Centre of Affordable Housing Finance in Africa, and we're based in Johannesburg, South Africa. Today I'm going to talk to you about extending access to housing finance across Africa. When you look across the continent at the cities that are growing very rapidly, you see two pictures. On the one side, you see evidence of really strong growth, GDP numbers that have been unsurpassed globally over the last 5 or 10 years in this continent. And you see beautiful inner cities and high-rise buildings going up, a lot of investment going into the commercial sector. And then you take a look around and you see slum housing and low-income housing and squatters, and you see that there's persistent poverty and that's not being addressed. Housing finance matters in this because housing is expensive and must be paid for. And we need to find a way in which we can overcome the affordability challenges while also addressing the very great need that is being expressed across all of our cities, where we see rapid urbanization, as high as 6% in Uganda, and population growth. So housing is as strong as its weakest link. The housing delivery chain, which extends from the delivery of land all the way through to the provision of socio and economic services and infrastructure, that whole process of housing delivery, each step in that chain needs to be paid for, and it is as strong as its weakest link. And we can see weak links across housing systems across the continent. And this impacts profoundly on the cost of housing and also the availability of housing finance. So first, taking a look at land assembly, the high cost of land and zoning, which pushes people out onto the periphery, or means that low-income people can't afford to live in well-located land, which then means that they have to pay higher for transport costs and further undermines their ability to sustain their lives. So land assembly and the availability of land is a critical issue. Title and tenure is the second link of the chain and impacts significantly on the availability of mortgages. Across the continent, we have very small mortgage markets, and we have our land registration systems that are now only just beginning to develop. And this means that it's very difficult for a lender to provide a large loan into the market because the collateral to underpin that loan just doesn't exist. And so attention to land registry systems and the speed with which title can be transferred is a critical issue. Bulk infrastructure and then socioeconomic infrastructure are both critical issues as well. And there it's the municipality that plays a very strong role. And in many of our cities across the continent, our municipalities haven't got the funding to invest in the infrastructure, which makes it possible for developers to move in and build houses. So paying attention to the way in which municipalities can raise the funds necessary through building taxation systems and so on becomes an important part of the housing delivery process, and something that investors are watching to see if they can invest in that particular place. Then we have the housing construction sector. And what we see across the continent is that primarily housing is built one by one, that households are building their own housing themselves, and that developers haven't got the capacity to build a large-scale development, say 500 units per annum over a period of more than 3 years. So they may build one development, but then the next one doesn't follow very quickly behind. And that's a function of the availability of construction finance, as well as the capacity of the developers themselves to take on such a big project. Then when we take a look at the sales and the transfer process and the availability of end-user finance, which makes it possible for a household with a particular income to afford so much more than they would ever be able to do with savings. That's the beauty of housing finance, is it provides affordability to pay for something so much bigger. But if we lack those end-user finance systems, whether mortgages or even housing microfinance, then people are going to be paying for their housing with savings, which means that they have to live in inadequate situations until they can save enough to improve the quality of their housing. Now that may well be fine in a rural area, but as you start to move into urban areas with the increasing pressures of urbanization and the density that's required in our cities, we can't afford to have houses that are built with inadequate materials and that are built without the necessary skills and technical support. So all of these issues together form the weak links in the housing value chain. And as each step of that chain needs to be paid for, the way in which you can ensure that the money gets put into that system is to make sure that those links are strengthened and improved. So there's 4 metrics now to understand the problem better. Annually, we ask housing professionals in the countries we survey how much the cheapest newly built house by a developer costs, and the prices range dramatically. This year, from $200,000 in Angola for the cheapest newly built house by a private developer, all the way through to houses that may cost about $10,000. In this graph, follow the orange bars for the costs in 2015 and the triangles, the orange triangles, for the size of those houses. Housing even at $20,000 per unit is unaffordable for the majority of households across the continent. We have to find a way to lower the cost of housing itself. In Kenya this year, the cheapest newly built house was $17,000, and at current lending rates, that's only affordable to about 10% of the population. The income required to buy this house is double the average annual household income in urban areas. A second metric we look at is the cost of a 50-kilogram bag of cement. Again, we ask professionals across all the countries we survey to tell us how much is the cost of that bag of cement this year. Countries with poor road infrastructure have expensive cement, and in this graph, again, follow the orange bars for the 2015 prices. Local cement production can decrease these costs, and we're seeing some of that increasing in recent years. In some countries, though, the cost of cement needed to buy a 40 square meter house is more than the average person earns in a year, and this influences building methods. It's no wonder that 84% of the houses in South Sudan are made from mud and sticks, and only 2% are made from bricks and mortar. A third metric is provided to us by the World Bank IFC's Doing Business survey, which they do every year. And in this graph, what we're looking at is data from 2012 compared with data from 2015. And again, the 2015 data is in the dark orange bars. Looking at this graph, we can see the number of days it takes to register a commercial property and the cost. When registration costs more than 10% of the property, or takes more than 2 months, can a low-income homeowner feel that it's worth it? Even in South Africa, therefore, informal transactions are common. The time it takes to register property is a serious disincentive to investment. As is evident in Gambia and Senegal, however, governments can have a real impact, and you can see that there are decreases there in both the time and the price of registering property. And finally, take a look at mortgage markets. And here we're looking at mortgage to GDP ratios and comparing that with the prevailing interest rates of mortgages in those countries and the term. Most countries offer mortgages at rates above 10% and for less than 20 years, highlighting the very real macroeconomic issues that challenge housing affordability. In Malawi, where the interest rate is 32%, one might as well buy a house with a credit card. The mortgage just isn't working in that context. As a result, African mortgage markets are tiny, and the data is limited, and we need to improve upon that. What is interesting from this graph is that lower interest rates seem to correlate with larger mortgage markets, and this is something for central banks to pay attention to. So historically, most governments have tried to go it alone, but their programs have been poorly targeted, haven't met the breadth of the demand, and we can see by the growth of informal settlements across the continent, they're not working. So how do we address this problem? We have to find a way to bring housing finance and private sector investment into the market. As a first step, the affordability of consumers is critical. We have to know how much a consumer can afford because they're part of the equation in terms of what the private sector can do in the housing finance that's offered. In this graph, what we're looking at is urban and rural populations and the annual household income distribution. And we can see that only between 3 and 5% of households, and these are ones that live in urban areas, have an income to afford a mortgage. Subsidies are not going to meet the rest of the demand across the population. But if we can segment the market and see the relative affordability of each of those income bands, we might begin to develop some solutions. And there are 6 that we'd like to talk about here. First of all, we need to increase access to mortgage finance and have lenders extend their mortgages lower down market. Secondly, we want to grow and develop housing microfinance. Third, we want to finance rental housing. Fourth, we want to target our subsidies very carefully, make sure they're well targeted. Fifth, we need data in order to know where to target these interventions. So we need to build solid data and information platforms. And finally, we need to pursue policy interventions across the value chain. So to start with the first one, increasing access to mortgage finance, there's 4 areas in which we can pay attention: risk, affordability and access, profitability, and let's start with funding. In terms of funding, an area that the World Bank has been spending a lot of time on is in the introduction of mortgage liquidity facilities. Now, a key challenge that mortgage lenders have is that they collect deposits from savers, and these are short-term in nature. Depositors want to get their money back quickly. And then they have to extend loans that should be long-term in nature if they're going to work for housing. And that creates a mismatch. So the way a mortgage liquidity facility solves this problem is that it creates a big pot of money, funding from government, from investors, and from the banks that want to use it so that they actually have some skin in the game, that those banks can draw upon when they run out of money because they've lent out all of the money that they had to their borrowers. So what this does, it increases the availability of long-term funding. So lenders are confident to lend out over longer terms, and that means then that the builders of the houses are confident to build because they know that there'll be finance that can be used to buy their houses. This also reduces the cost of funding, which reduces the lending rate, which makes housing loans more affordable, and it reduces the barriers to entry for smaller mortgage lenders. The whole process leads to a standardization of the mortgage market, which makes it easier for investors to understand risk and engage with all of the players. And so far, there are 4 mortgage liquidity facilities across the continent. The one in Egypt was started in 2006, in Tanzania in 2010, in the West African Economic Union in 2012, and in Nigeria just recently in 2013-2014. So we'll look to see how those proceed. But it's a very useful way to put liquidity into the market and deal with the funding challenge. A second way to improve access to mortgage finance is to address risk. And here, a very interesting initiative was done by Fogarim in Morocco. And basically what they've done is they've created a guarantee that banks can draw on, and the guarantee specifically targets low-income and informally employed workers. So banks know that if they lend to this high-risk target market, if something happens in terms of the repayment of that loan, they can access the guarantee from Fogarim. And this program has led to the extension of over 120,000 mortgages by June 2015. So it's having a significant impact on access to mortgage finance in Morocco. A second way to deal with risk and also address affordability is an initiative that's being championed by Home Finance Guarantors Africa Reinsurance Limited. And they provide a collateral replacement guarantee, which basically replaces the deposit required by the borrower, so that the lender doesn't have to provide 100% mortgage, but the borrower is able to participate without having to raise all of the finance. So that the lender can offer 100% mortgage, but with only 80% exposure, while the borrower doesn't have to provide a deposit, which means that they don't have to wait all those years it takes to save the 20% of the purchase price. Another way of addressing access to mortgage finance is by looking at affordability and reducing the cost of housing, and doing that by splitting up the process into a more incremental delivery process. Zambia Home Loans is offering mortgages that allow for the ongoing construction of a house over time. So this offers an opportunity for lower income earners to start with a smaller mortgage and then graduate it as they improve their housing and build it over time. Finally, a focus on profitability. If lenders and developers feel that they can realize a return or a yield for their investors that is worthwhile, then they will invest, and that will increase scale and bring prices down. And here government has a critical role to play through the delivery of public-private partnerships. Public-private partnerships get each player in the development process to play their particular role. So government reduces the risk by reducing the time and the cost of following all of the regulatory approval processes. And they may well also put land in. Government has very large land holdings in many cities. The developer takes on risk of the development and puts investment in, and also their capacity in terms of building the actual development. The developer is in a better place to do that if they know that the government is going to make sure that this process may well be fast-tracked. And that's something governments can do, is to fast-track a particular segment of the market to make sure that that housing gets delivered and encourages more players in. So we've talked about mortgage finance and how to extend access to mortgage finance. A second way to address the housing finance challenge on our continent is to look at microfinance. Not all households, and in fact the minority of households, will be able to access mortgage finance even with all of those interventions. So focusing on microfinance, which is unsecured finance for housing purposes, is a very interesting approach to take. And here we're looking at how to finance the individual stages, those links in the chain, with microloans. There are very interesting examples in Angola with Kecia Rust, and also in Malawi, where Select Africa has partnered with Habitat for Humanity to make sure that while a borrower gets a microloan for housing purposes, they also get technical capacity to make sure that the house they build is good quality. A third area to extend access to housing finance broadly is to focus on rental housing and to stimulate the rental market. And this does two things. On the one side, it means that there's a wider diversity of housing available. But what it also means is that if a borrower with a mortgage gets into trouble, they actually have somewhere to move to if they need to get out of their mortgage arrangement and sell their house. There are different markets that can be attended to in the rental market: urban workforce, student housing, and then particular niche markets. And one interesting one that's worth looking at is with small-scale landlords and backyard rental. So here's a case of a backyard rental landlord. This woman lives in Soweto, which is a township in Johannesburg, South Africa, and she had this pink house. She then was able to drag the container that you see her standing in front of onto her property and start filling it with some stock, bread and milk and sweets and so on, which she sold. She took out a microloan to put more stock into her little shop, and there she was serving the local market. With the money she earned from that, she could take out a loan and build the backyard rental units, which are in the back behind the pink house. And there she's offering accommodation for 3 other people in the backyard rooms, and that's formal waterborne sewerage, and she's earning a rental income. What's important about small-scale landlordism is that it creates an income stream for the landlord, affordable rental for a tenant, and it stimulates the construction sector at the bottom end. The fourth area that I talked about in terms of extending access to housing finance is to target subsidies very carefully. And here the story of South Africa offers a really useful example. If we take a look at this affordability triangle for South Africa, you can see the green triangle at the very top. Those are households that are adequately supplied with both new and resale housing and also a rental market. At the very bottom end, the yellow zone, about 50% of the population, was able to access government-subsidized housing. And the government has so far built almost 3 million units across the country. But as a result of this property market and how it's evolved over the past 20 years, what's emerged is a gap market in the middle, where we have inadequate supply of resale and rental, and very, very limited resale. And this is covering about 30% of our population. So be careful to how you target your subsidies and pay attention to the unintended consequences that may arise out of this. The fifth area in terms of how to extend access to housing finance across the continent, we need more data. We don't have enough data and information to encourage investors that this is a viable market. There's lots we need to know and understand. But as a first step, we really need to understand the affordability of our target market, both in terms of income and expenditure and their financial lives, so that we know how to target our housing developments, and so that we don't have a development, as happened in Calamba, Angola, where the government argued they were building affordable housing, but those units were priced at $120,000 per unit, which is affordable only to a tiny fraction of the population and certainly not the target market they were trying to serve. We also need to understand the risk profile of the market we're trying to serve, so that our products are well designed and aren't overly expensive because they're trying to cover risks that actually don't exist. So to monitor and track the performance of our loans and how our borrowers engage with that is a critical area of attention. So to start to address some of these issues, we've been developing a yearbook. This in 2015, it was the 6th edition, and we're covering 48 countries, looking at what do the housing finance markets look in those countries, and what are some of the opportunities that might exist for investors and areas where governments should look at. And the 6th area that we need to pay attention to if we're going to extend access to housing finance is that we need to pursue interventions along the value chain. Now, housing policies have a major impact on house prices, on quality, on crowding, on tenure choice, on residential mobility, and they can have both positive and negative choices. And governments need to understand that their policies can influence investment decision-making, as well as borrower or household decision-making in terms of where they want to live and how they want to live. Policy is critical. Government policies are also needed to enable each part of the value chain so that we look at our regulations and our laws and our various institutions that we have and the different levers that governments can apply in terms of taxation and monetary policy, macroeconomic policy, subsidization, and so on. All of those, government can have a significant impact on the housing market. But often what we've seen is that government policies hinder effective market development and have the opposite effect of what we want. The data and information that we collect and our experience as we develop good case studies and survive bad experiences, all of these can help governments understand what's needed in order to make the housing value chain more effective. So, some things to think about. There is huge scope for growth in the mortgage market. We've got an estimated potential of 6 million mortgages across Africa, and this could equal $300 billion worth of investment, or 18% of GDP for Africa. 12% if we didn't include South Africa. The macroeconomic and land reforms that we're seeing happening across the continent are making this easier. 61% of urban residents in Africa, however, live in slums, and the majority of those will not be able to access mortgage finance. There is affordability for credit, however, and there's real growth that we're seeing in the microfinance sector. How do we channel this growth into developmental purposes and the focus and opportunity of housing in this space? Most governments can afford to subsidize something, not everything, but something, and land is a very real opportunity in this space. What we see is that most houses in Africa are self-built, and what this means is we're not achieving the scale that we require. We need developers. But to afford the risks, our current developers are building for the rich. So if governments can reduce the risks by at least improving the time and reducing the cost of regulatory approvals, that can have a big impact. This year, we saw that the cheapest developer-built house in Angola was $200,000. That's impossible. We can't have a market that works just for the high end. And we've also seen that only 2% of houses in South Sudan are made out of brick. We have to come up with another affordable approach. Is there an issue around construction finance? It's certainly something that needs a lot of attention. Our housing policies, however, are still often draft. We have them written, but they haven't been signed. Investors are keen to enter the market, but they can't do that if they're not sure what the rules of the game are. And so they need to understand what the policy is and what the regulatory framework. There have been some interesting developments in Kenya, Tanzania, Nigeria, Morocco, Ethiopia, Cote d'Ivoire. So we have some very good experience on which to draw upon. And policy is a critical ingredient in the housing delivery process and fundamental to what allows housing finance to flow. And I think it's interesting to think about how the private sector might influence policy as well through its product innovation. So keeping an eye on that sector and what they're doing to realize market opportunity is important. Across all of this, we need to think, do we have the right data to understand the problem and to begin to chart a solution forward? So I'd really like to ask you to join me in collecting that data and promoting housing finance markets across the continent so we actually can extend housing finance to all. Thank you.